Most people get into the financial markets to make money, but 90% of them start off on the wrong foot for one simple reason. They don't know if they are a trader or an investor. They try to day trade with an investor's mindset, or they try to long-term invest while checking the stock market 50 times an hour. The result? Unnecessary stress, missed gains, and burnt capital. In this video, we're breaking down trading versus investing, step by step, the core mechanisms, time horizons, risk profiles, tax realities, and most importantly, how to figure out which strategy fits your personality, goals, and daily schedule. At its core, the primary difference between trading and investing comes down to time horizon and what you base your decisions on. 1. What is trading? Trading is active management. A trader buys and sells financial instruments, stocks, forex, crypto, or options over short time frames. This can range from second scalping to hours day trading or days to week swing trading. Traders aren't primarily focused on whether a company will change the world in 10 years. They care about price action, liquidity, volume, and market structure right now. 2. What is investing? Investing, on the other hand, is wealth accumulation over time. An investor buys assets with the intention of holding them for years or even decades. Investors focus on fundamentals, earnings reports, moat, management quality, cash flow, and macroeconomic cycles. When the market dips, a trader sees a stop-loss hit. An investor sees a discount. Feature, trading. Investing primary tool, technical analysis, and price action fundamental analysis and valuation time. Commitment high, 2 to 6 plus hours. Day low, a few hours. Month, risk. Profile high volatility per trade market risk over time capital growth compound via high frequency compound via market growth and dividends key, mindset, execution discipline, and probability patience and conviction. Let's look at what this actually means for your daily life. The trader's reality. Trading requires active screen time. You are managing risk per trade, placing stop losses, evaluating liquidity sweeps, and managing execution. A single mistake in risk management can wipe out weeks of steady gains. It is essentially running a high-intensity micro-business. The investor's reality. Investing relies on the power of compounding. By buying high-quality assets or broad market index funds in, letting them compound at historic market averages, like the S&P 500's, long-term approximately 10%. Historical average, you leverage time rather than screen hours. It requires extreme patience rather than fast execution. There are two major factors that most beginners overlook when choosing between trading and investing: taxes and psychology. 1. The tax impact. Visual, graphic illustrating short-term capital gains tax versus long-term capital gains tax. Depending on your jurisdiction, trading gains are generally treated as short-term capital gains or income, which are taxed at significantly higher rates. Investors who hold assets for more than a year typically qualify for long-term capital gains rates, allowing them to compound wealth far more efficiently without friction from constant tax events. 2. Psychological friction. In trading, you face instant feedback, constant wins and losses daily. It demands emotional detachment, strict discipline, and strict adherence to a strategy, even during losing streaks. In investing, the psychological challenge is holding through multi-year market drawdowns without panic selling when headlines are dark. Here's a secret that experienced market participants use. You don't always have to choose just one. Many top market participants use the core and satellite model. The core, 70 to 80% of capital placed in long-term investments, index funds, dividend growth assets, or blue-chip holdings for long-term wealth building. The satellite, 20 to 30% of capital allocated to active trading, intraday swing setups, or habeta plays to generate active cash flow without risking overall financial security. This gives you the stability of long-term compounding while allowing you to capitalize on short-term market inefficiencies. So, which path should you choose? Choose trading if you have time to dedicate to the screens daily, enjoy technical analysis, thrive under fast-paced decision-making, and have disciplined risk management. Choose investing if you want a low-maintenance way to grow long-term wealth, prefer analyzing business fundamentals, and want to leverage compound interest without staring at charts all day. If you found this breakdown helpful, hit that like button and subscribe for more market insights. Drop a comment below. Are you currently a trader, an investor, or using a hybrid strategy? Let's start a conversation down in the comments. Thanks for watching, and I'll see you in the next video.